every great trader has a built-in process to analyze the markets and make money. So today I'm sharing my personal 3-step trading system that has made me thousands of dollars each month consistently. So whether you're starting out in trading or you are a seasoned investor, this 3-step strategy will definitely boost your trading results and help you make more money in any financial market. So Lion Army, without further ado, let's just jump right in. So step number 1 is comprehensive market analysis, which basically means we need a good understanding of the financial market, and we can achieve this understanding by 3 main points. These are learning to identify overall market trend, finding and understanding key market levels, and monitoring economic indicators. These 3 points will give you a solid base understanding of what is actually going on when you trade, which will also force you to make better trade decisions. Now, to identify the market trend, we want to use the higher time frames. Why? Well, it's simple. We want to follow the overall market direction rather than a short-term retracement. There are 3 things the market can do, which is go up, go down, or go sideways. We want to determine which of the 3 cycles the market is currently at and trade with it. Here's an example. We're currently looking at the monthly time frame on the USD Japanese yen currency pair. We can see that the overall market direction is bullish, right? It's going towards the upside. If for any reason we have some trade skepticism, we can use trend lines, moving averages, or price channels to further confirm what we're seeing is true. On top of that, we want to identify key trading levels so we can focus on what actually matters in the market rather than looking at the previous data. I'll give you an example. So the first key trading level is, of course, support and resistance. We can see a nice resistance just here and a beautiful support line just over here. Just marking this data on the higher time frames gives us great buying and selling opportunities. We could have bought over here on the support or short this trade just over here after we saw the red bearish candlestick for a nice retracement trade. So what I'm telling you, you look at the higher time frame first, and then you can go to the lower time frame and see where the market is currently at. And once the market actually reaches one of the key levels, let's say where the 20 moving averages and the support over here, this gives strong confluence, and then you can enter the trade for a nice buy, and you would have made a ton of money trading crypto, forex, or stocks, because this way of trading works in everything. Now, still talking about key levels, there's a thing called high and low of the previous month or day. What I like to do personally is mark previous month's high and low just over here, and then go to the lower time frames, let's say the daily. So this was the previous high, this was the low. I know once it touched the 50 moving average and it's near this area of previous high and low level, I know that likely on the daily time frame there's a trading opportunity. And if I waited another day just over here, this could have been a beautiful trade for a nice retest of the previous top level. And this is very easy to achieve once you combine everything together. So that's 2 key levels, but there's one left I really like using, which is pivot points. And I love pivot points a lot. I like to use the ones in babypips.com. The monthly real-time pivot point is the one to go for. As we can see, 155711. If we mark it on our charts, there's the pivot point. It basically calculates everything for you, what happened from the last month to this one, so it already predicts what's likely to happen. And as we can see, the candlesticks did break past the pivot point and it did shoot towards the upside. So if we enter this trade after the bullish engulfing candlestick and the 20 moving average close, we can see that it would have been a nice 157 pips profit, basically again retesting the previous area top. By marking these zones is way less stressful. You know when to enter the trade and when you close the trade because you have key area points. You can always have support and resistance, nice pivot points, day high and low, everything marked up, so you can anticipate whether the market will turn and where you should take your profits. Trust me, practice this. It will definitely help you out. So I gave you a bullish example. Bearish market will be the same, but we didn't discuss a sideways market, and it's a little bit different. So the first thing we want to do is look at the overall market direction. As we can see, it's trending towards the downside clearly. But what is happening over here is currently consolidating, right? We have our previous area of support, and we have our resistance line. If the market is consolidating, the best thing you can do is still trade the overall market direction. Since we know that the higher time frame direction is bearish, we want to be only selling rather than buying. So we never want to buy just over here. Yes, even though it could have been a profitable trade, the probability is definitely lower. So of course we wouldn't be entering trades on the monthly. We would go to the weekly, daily, 4-hour. So let's take a look at the weekly. Look at this. It broke the 200 moving average, which is the green line, and then it broke back and then went towards the downside. Look at this. This is the attempt over here. It bounced off the 50 line because the strong confluence resistance is here. It's not likely to break it straight away, and this is what I'm talking about. So this could have been a trading opportunity here and here. Look at this beautiful drop towards the downside every single time because the overall market direction is bearish. We have the moving average covering our butt. Monthly moving average is over here as well. And we can take a look at the 4-hour price action as well. Look at this. Beautiful trades. Yes, it's trending towards the upside on the lower time frames. It doesn't matter because the higher time frames always take priority. And once you are sitting somewhere over here where the previous resistance was, you're looking for candlesticks that have a lot of selling pressure, like this one over here, which is the bearish engulfing candlestick. And as we can see, it's straight away pushed towards the downside, and this is where you could have entered your position. You basically ignore the lower time frame moving averages and continue trading, and this would have been 180 pips profit. Easy money to be made. Trust me, practice this. Lastly, it's always good practice to know any economic news events that are coming up, such as the CPI, interest rates, gross domestic product, or non-farm payroll. So here's an example for the non-farm payroll. Look at this. The market is currently trending towards the downside. It's making new lows. It managed to break the 200 moving average, the 20 and 50 over here. Candlestick is sitting around this area level. However, it's Friday, and the first Friday of the month is non-farm payroll, and we're currently sitting on a strong area of support level. If the non-farm payroll news for the US dollar is negative, euro might push up, and as we can see, the market did push up and it broke past all of the moving averages, and then we can simply enter the trade covering the two simple moving averages, 20 and 50, and we can do a 2-to-1 to 3-to-1 risk to reward simply by allowing the non-farm payroll to happen, break the previous area of structure, and continue trading on. And look at this, the market does push towards the upside, hitting around 227 pips profit. Okay, we are now in step 2, which is creating a structured yet adaptable trading plan. Having a trading plan that's adaptable will help us make money without any guesswork. We can achieve this again with 3 main points, and the first step is setting a clear entry and exit criteria. In our trading plan, we have to define multiple conditions that have to be met before we can actually take the trade. These conditions can include specific price levels like round levels, psychological levels, technical indicator breaks. Let's say we have our moving averages and the candlesticks break just over here, shows bearish momentum. That's great for us. We also want to look at our technical indicators on the higher time frames as well as the lower time frames to see whether they are all trending in the same direction. As we can see, the moving average has been broken by this candlestick over here, showing bearish pressure. We can also have a look at chart patterns. There was a beautiful M pattern, which is a double top. If we break the neckline, which we did, suggests further movement towards the downside. So the way you trade the neckline is simple: top and bottom of the neckline, drag it across just over here. So it's telling us it's pretty much heading towards this area direction, which is pretty much a strong solid support. And since now we have nice trading conditions that are favorable for our trade, covering our previous area of resistance and the 50 moving average, and this would have been, I'm pretty sure, a great trading opportunity. There we go. Around 1.2 risk reward. So for every $100 we're risking, we are making 200. Okay, second point is very important, and it's understanding a if-then scenario. So let's say we have a nice little channel over here. Every single time it touches, we can enter the trade and it goes up and we are very profitable. But it's a fact that the channel won't just continue going towards the upside, right? We know that eventually it's gonna break, and if it does, we need to be prepared for it, right? So what if it does break and it continues dropping down? Well, what do we do? Well, where do we close the trade? Well, if we entered our trading position just over here, maybe off this bullish engulfing candlestick just around here, we need to have a proper stop loss. So if it breaks the 50, let's say just around here where the candlestick was, we lost 52 pips. Okay, that's fine. After we lose, what we want to do is just watch the market. What is it actually going to do next? Is it a fake out, or is it actually going to continue dropping down and develop a downtrend? So now let's see what happens. And it manages to break the 200 moving average. As we can see, nice little break. This is the 200. Pulls back. After it breaks out and pulls back, we don't want to enter the trade straight away because that's the initial breakout. After a push, there's always an exhaustion. So there's the exhaustion happening over here, going towards the upside, retesting the previous area of resistance just around here. What we want to do is wait for another breakout of the green line. So as we can see, we have a nice breakout over here, and it's a new low. This is a substantial move towards the downside. We don't want to enter just the breakout yet. We want to wait for double confirmation exhaustion. So where do we enter? We wait, and we want to enter on a nice candlestick formation, something like this. Look at this, push, exhaustion. This made a new low. So here, new low, nice push, nice exhaustion. So we can enter just here, stop loss 50 pips, 100 pips take profit, 2-to-1 risk to reward minimum. And let's see what happens. After that, it just continues dropping down and starts following a new trend towards the downside. And if we use the price tool yet again, we can see how the price reacted. Went down, went up, reacted towards the moving averages, and started dropping down. There's also a middle line just over here where it's respecting. If it breaks the middle line, it further continues dropping down. That's how price channels work. But as we can see, if we were prepared this is gonna happen, we could have closed the trade pretty early, you know, just a simple 50 pip loss and potentially get a nice 100 pips. So we recover what we lost, plus we gained 50 pips back over here simply because we found out that the market is actually reversing. So the last point is risk management, and it's probably the hardest thing to do when you're trading, but I'll give you a few tips and they're gonna definitely help in your trading. So the first thing, you always want to enter trades where you're covering the moving averages. You never want to enter trades somewhere over here. Even though the market is pushing down, it's likely gonna have a retracement back. And look, if the retracement did happen, you would have been stopped out. And this happens to a lot of traders. Even though their direction bias is correct and it continues dropping down, they first get stopped out before this does happen. Another thing is having your stop loss big enough but not being afraid to close early. So why you want to have a stop loss big enough? So you always want to cover all of the moving averages in case it has spikes. Spikes don't mean candlestick closures. If the candlestick is moving, has a spike, and then drops back down, that's fine. You don't want to close off the trade. However, if it continues dropping down and actually closes, let's say on the 4-hour time frame, above all of the moving averages, it could mean that the market is actually coming towards the upside. So even though your initial stop loss was 50 pips, you can mitigate the risk by half, let's say 25 pips, if it closes just above all of the moving averages. So step 3 is market psychology. You need this to make money when trading, so listen up. Always want to anticipate what others are actually doing, and there's a few websites for that. So I like using bar chart, COT reports just to take a look. So we're currently on Euro GBP daily time frame, and as we can see, Euro British pound has been sold off. So if we take a look, May 28th, just around here, it started respecting heavily of this resistance line and dropped. Want to know this information just to follow what the hedge funds are doing, because they are the ones that are moving the market. Now this data is 3 days late, so it's not always accurate. So there's another thing you want to look at, which is called the market sentiment. Now specifically for Forex, I like using Forex market sentiment on my FX book. This website just shows what verified traders, real traders, are actually doing and which positions are being held, whether it's a sell or a buy. As we can see, USD CAD has a lot more sellers rather than buyers, and we can assume that maybe the market will continue to drop. And if you're interested in stocks, maybe try a fear and greed index. You can Google them, there's a ton of them, which shows pretty much stock momentum, how the stocks are doing, whether it's in fear or greed or extreme greed. Trust me, it's very interesting and it's very helpful when you want to make proper trading decisions. I'm 100% sure crypto has one as well. So by thinking like other traders or thinking like banks and hedge funds, you will definitely have an advantage in the markets. And if you found this video helpful, make sure to give it a like. If you're interested, I have a Forex Signals group. We are smashing the markets as always. And you might be interested in my pullback trading strategy. Trust me, this is the way I trade pullbacks, and I've been trading 10 years. So if you want to learn the strategy, make sure to watch this video next. And peace out, Lions. Take care. Have a wonderful day.